I've read thousands of books in my life, literally thousands. I read 5-6 hours a day, even now at 70 years old. And people ask me all the time, Bill, what's the most important book you've ever read? And I always give them the same answer without hesitation. The Intelligent Investor by Benjamin Graham. That book changed my life. It shaped how I think about money, investing, and building wealth. It's the foundation of everything I've done, from starting Microsoft to managing my investments through Cascade, and even guiding the work at the Gates Foundation. I first read it back in the late 1970 seconds, right after I dropped out of Harvard. I was young, ambitious, and trying to figure out how to turn my passion for software into something lasting. Ben Graham's ideas were like a light bulb going off. They taught me that success comes from disciplined analysis, not chasing trends. When I read that book, it felt like scales falling from my eyes. Suddenly, investing made sense. Suddenly, I understood how the stock market really worked, not as a casino, but as a place where patience and analysis win out. That book made me rich. Not directly, of course. It didn't hand me money, but it gave me the principles, the framework, the philosophy that allowed me to build wealth. And today I want to share those principles with you, because here's the truth. If you understand and apply what's in The Intelligent Investor, you can become a millionaire. Not might become, can become. The path is clear. The principles work. They've worked for me for over 50 years, and they'll work for you too. I've applied them not just to stocks, but to building companies, to philanthropy, even to solving global problems like health and education. So let me take you through the key lessons from this book, the lessons that made me rich, and more importantly, how you can use them to reach your first $1 million. I'll weave in some stories from my own journey, because theory is great, but seeing it in action is what sticks. Let's start with the most fundamental concept in the book, the difference between investing and speculation. Most people think these are the same thing. They use the words interchangeably, but they're not. They're completely different. And understanding this difference is the first step to building real wealth. Here's how Graham defined it. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Everything else is speculation. An investment has three characteristics. First, you've done thorough analysis. You understand what you're buying. You know the business, the industry, the financials. Second, safety of principal. You're not likely to lose your money. You're buying at a price where even if things don't go perfectly, you're probably going to be okay. Third, an adequate return. Not a spectacular return, not a home run, just adequate and reasonable. Everything else is speculation. If you're buying because you think the price will go up, but you haven't analyzed it thoroughly, that's speculation. If you're buying at a price where you could lose most of your money, that's speculation. There's nothing wrong with speculation. Graham himself speculated sometimes, but you have to know which one you're doing. You have to be honest with yourself. The problem is most people speculate while thinking they're investing. They buy stocks they don't understand at prices that don't make sense, hoping to get rich quick, and then they're shocked when they lose money. When I started Microsoft in 1975, Paul Allen and I weren't speculating. We were investing our time and energy based on thorough analysis of the personal computer revolution. Later, when I began investing my earnings, I followed Graham's approach. I only bought things I understood. I only bought at prices that offered safety of principal. I aimed for adequate returns, not spectacular ones. Over decades, those adequate returns compounded into spectacular wealth because I wasn't losing money on bad speculations. So that's lesson one. Know the difference. Be an investor, not a speculator. The second major lesson is the concept of Mr. Market. Graham said to imagine the stock market as a person. Every day, Mr. Market shows up at your door with an offer to buy your shares or sell you his shares. Some days he's optimistic and euphoric, offering very high prices. Other days he's depressed and pessimistic, offering very low prices. And the key insight is this: Mr. Market is irrational. His prices don't reflect reality, they reflect emotion. So what should you do? Ignore his mood, focus on the actual value of what you own, and only transact when it benefits you. When Mr. Market is euphoric and offers absurdly high prices, consider selling. When he's depressed and offers absurdly low prices, consider buying. Most of the time, ignore him. This concept saved me during every market crash I've lived through. In 2000, during the dot-com bust, the market plunged and people panicked. But Mr. Market's depression didn't mean the businesses I owned had become worthless. Microsoft was still innovating and growing. Solid companies were still operating. Mr. Market was offering absurdly low prices. So instead of panicking, I bought more. Same thing in 2008 during the financial crisis. Mr. Market was having a meltdown, offering crazy low prices, and I bought because I understood the mood was temporary, but the value of good businesses was permanent. Most investors do it backwards. They get excited when prices are high and scared when prices are low. They buy high and sell low. But if you understand Mr. Market, you do the opposite. That's lesson 2. Don't let mood swings control you. Use them. The third crucial lesson is margin of safety. Graham called it the central concept of investment. Margin of safety means you only buy something when the price is significantly below what it's actually worth. The gap between price and value is your protection. If you think something is worth $50 a share, you don't buy at $50 because your analysis might be wrong. But if you can buy at $35, you have a margin of safety. Even if you're off by 20%, you're probably okay. This is how you avoid losing money. Not by being perfect, but by buying with protection. I've followed this principle my entire career. I won't buy something at a fair price. I'll only buy at a good price. A price where even if I'm somewhat wrong, I'll probably be fine. Yes, it means I miss opportunities. Some great companies never offered a sufficient margin of safety and went on to do well. That's okay, because the investments I did make with a margin of safety worked out extremely well, and I haven't lost much money because the margin of safety protected me when I made mistakes. Graham said it perfectly. The margin of safety is always dependent on the price paid. Large at one price, small at another, non-existent at a higher price. That's lesson 3. Always insist on a margin of safety. The fourth lesson is practical dollar cost averaging and long-term investing. Graham recommended a simple approach for most investors. Invest a fixed amount regularly into a diversified portfolio of stocks and bonds, rebalance periodically, and hold for the long term. You invest the same amount every month, whether the market is up or down. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, it averages out. You're not timing the market. You're just investing consistently. Let me give you numbers. Invest $500 a month in an S&P 500 index fund. That's $6,000 a year. Over 30 years at a 10% average annual return, you'd have about $1 million. You invested $180,000 and compound interest turned it into $1 million. That's the power of consistent long-term investing. Most people don't need to be clever. They need consistency and time. That's lesson 4. Invest regularly, diversify, and hold long-term. The fifth lesson is about temperament. Graham said investing is not about intellect, it's about temperament. You need the temperament to avoid panic when things go wrong and greed when things go well. I've known smart people who failed because they panicked during crashes and got greedy during booms. I've known people who weren't brilliant but had the right temperament, stayed calm, stuck to principles, and became wealthy. So what is the right temperament? Patience, because real wealth takes decades. Discipline, because you follow your principles even when it's uncomfortable. Emotional control, because you don't let market swings control your mood. Graham emphasized this. The investor's chief problem, and even his worst enemy, is likely to be himself. Fear tells you to sell at the worst time. Greed tells you to buy at the worst time. You have to resist. That emotional discipline has been worth billions to me, not because I'm smarter, but because I can control my emotions better. That's lesson 5. Temperament matters more than intelligence. The 6th lesson is often overlooked: reading financial statements. Graham said an intelligent investor must understand the basics of financial analysis. You don't need to be an accountant, but you need to read a balance sheet, an income statement, and a cash flow statement. You need to understand basic metrics like price to earnings ratios, debt to equity ratios, return on equity. Why? Because this is how you do thorough analysis. You can't buy based on gut feeling or tips. You have to look at the numbers. When I was young, I spent countless hours learning this. I'd get annual reports, go through them line by line, calculate ratios, compare companies, and look for undervalued businesses. This skill has been fundamental to my success because I can look at financials and understand what's really going on. Most people skip this step and buy based on headlines or whatever's popular, and they have no idea what the underlying business is worth. Graham taught me to always do the analysis, always understand what you're buying, never invest in something you haven't thoroughly analyzed. That's lesson 6. The 7th lesson is about the dangers of following the crowd. Graham warned repeatedly about investors following popular opinion instead of thinking independently. The crowd often disagrees with disciplined analysis. You have to be willing to be contrarian when the analysis supports it. That's lesson 7. Don't follow the crowd. Think independently. The 8th lesson is the importance of diversification. Graham said diversification is an established tenet of conservative investment. He recommended most investors own 10 to 30 different stocks across different industries because even with thorough analysis, you can be wrong. Diversification protects you. If you own one stock and it fails, you lose everything. If you own 30 stocks and one fails, you lose about 3%. It reduces risk without significantly reducing returns. The easiest way to diversify is index funds. An S&P 500 index fund gives you ownership in 500 companies across major industries. You're instantly diversified and protected against any single company failing. That's lesson 8. Diversify and protect yourself against mistakes. The 9th lesson is about avoiding debt and maintaining financial conservatism. Graham was conservative about debt. He believed companies should have strong balance sheets with manageable debt, and he believed investors should avoid borrowing money to buy stocks. Margin magnifies gains when things go well, but it magnifies losses and can wipe you out when things go badly. I followed this strictly. I've never used margin to invest, never borrowed money to buy stocks, and I've preferred companies with little or no debt that can weather storms. This conservatism protects you during crises. Companies with too much debt can go bankrupt in downturns, while strong companies survive, buy assets cheaply, and emerge stronger. The same applies personally. If you're in debt, you can't take advantage of opportunities and you're vulnerable to setbacks. If you're debt-free with savings, you have flexibility. That's lesson 9. Avoid debt. Maintain strong foundations. And finally, the 10th lesson ties everything together. The goal of investing is not to beat the market. It's to build wealth steadily and safely over time. Graham wasn't trying to find the next big winner. He was trying to make adequate returns with minimal risk to build wealth without losing money. And that approach often works better than trying to beat the market. Because when you try to beat the market, you take more risks, make more mistakes, and losses compound. But when you focus on steady, safe returns, you avoid big losses and keep compounding. Over decades, adequate returns become spectacular wealth. I've never tried to beat the market every year. Some years I do better, some years worse, but I focused on consistent, steady returns with minimal risk, and that led to extraordinary wealth. Don't try to get rich quick. Don't try to beat the market. Focus on building wealth steadily and safely over time. That's lesson 10. So there you have it, the 10 key lessons from The Intelligent Investor, the book that made me rich. Let me recap them quickly. 1, know the difference between investing and speculation. 2, understand Mr. Market and use his mood swings to your advantage. 3, always insist on a margin of safety. 4, invest regularly, diversify, hold long term. 5, develop the right temperament, patience, discipline, emotional control. 6, learn to read financial statements and do thorough analysis. 7, don't follow the crowd, think independently. 8, diversify your investments to protect against mistakes. 9, be financially conservative and avoid debt. 10, focus on steady, safe returns over time, not beating the market. If you follow these principles, you will build wealth. Not overnight, not in a year, but over time. Steadily and safely, you'll reach $1 million and then more. These principles work. They've worked for me. They've worked for thousands of other successful investors. They'll work for you if you apply them. But here's the key. You have to actually apply them. Reading isn't enough. Understanding isn't enough. You have to live them and make them part of how you think about money. So here's what I want you to do. First, get a copy of The Intelligent Investor. Read it slowly, take notes, think about each principle. Second, start applying the principles. Open an investment account if you don't have one. Start dollar cost averaging into index funds. Start building that margin of safety and developing the right temperament. Third, be patient. This is a lifelong journey. You're not going to be a millionaire next month or next year. But if you follow these principles consistently for 10, 20, 30 years, you'll get there. I promise you that because the math works, the principles work, and compound interest works, you just have to give it time. The Intelligent Investor changed my life. It can change yours too. Not because it's magic, but because it teaches timeless principles anyone can learn and apply. So get the book, read it, apply it, and start your journey to $1 million using the same principles that made me one of the richest people in the world. Thank you for watching. Now go become an intelligent investor. Grab that book today and take your first step.